Welcome to the walkthrough for slides for Chapter 7, the financial system and interest. In this chapter, we'll cover the financial system, which we've talked about a lot, so we'll just, briefly remind you of some of the things we've already talked about, stock market and stock exchanges, interest, and as we discussed on Wednesday, really focus in on the components of interest rate to understand that some of those terms will come in handy later when we're talking about cost of capital. The financial system, as you know, there's basically people with money and there's people who have money, and the financial system exists as an intermediary to help savers earn a return on their excess cash and people to invest other people's funds in growing and expanding their businesses. So that's why financial systems exist, to facilitate that flow and of both the interest or repayment as well as the investment. So this is a demand and supply sort of market, which is interesting. You've got people issuing securities, so businesses issuing securities like bonds or shares, and then you've got folks who are purchasing those bonds and shares in exchange for cash. So that's what they're up to. And then interest comes from the bonds, and dividends and price appreciation from shares. So again, remember the concept of yield, which we're obviously digging into this chapter. We've got two components in both cases, the principal value change and the income stream, which is interest or dividends, depending on whether it's bonds or shares. So raising and spending money in business. Basically, businesses have two different prime modes of spending money. One would be operating, so inventory, wages, all those things that you need to run every single day. And then capital investments, which are long-term investments for the business to grow. So those key sort of assets and expansions that needs to happen. And so day-to-day operations typically comes from, revenue, basically profits. Can also come from working capital financing, which we discussed in the last chapter. But then capital expansion is definitely where you go out to the financial market and get money from others, because you need a significant amount of money usually for these types of investments. Borrowed money is debt financing, and money raised through the sale of shares is equity financing, just to clarify how we use those two terms. Now, the term is the length between now and the termination of something. There's a nice easy way to remember it. And this is just as we discussed in our chapter on bonds, which you guys covered before this chapter. It's in a different sequence, obviously, in the text. This is something you're familiar with. And there's this really important maturity matching principle that says that long-term projects should be financed with long-term financial instruments, and short-term projects should be financed with short-term financial instruments and financial tools. And that's the maturity matching principle. It's really important in finance. And as we discussed, I don't know whether TELUS follows this. Certainly in the past, they have used short-term financing for long-term projects because of lower interest rates. I know that's definitely a hallmark of what TELUS has been doing. And what I'd be curious about when we have our executive in residence available at our last session would be whether or not they continue, what does the future hold essentially for TELUS, regardless of where they've been and what they're doing now. How do they feel about sticking to maturity matching? Is that something they pay attention to, or are they more interested in just securing financing at a low interest rate, even if it's not necessarily matched with the asset? So anyway, something that we'll see. Financial markets. So there's capital markets, which are the long-term markets, including all equity markets, and then money markets, which are the shorter term 1 year or less maturity terms. So capital includes equities and bonds of anything greater than a year. Money markets are debt instruments that are less than 1 year. Primary markets, you guys totally know what that means. So if you don't know, look it up at this point, because I know you guys know what primary and secondary markets are very well. So again, capital markets are long-term, money markets are short-term, and the 1 year mark is how we determine whether something is money market versus capital market. Commercial paper notes bills, good. We've covered that, and T-bills. So some of this stuff you've already covered because this chapter again is out of sequence, and in chapter 7 you covered a lot of this information. We've covered primary and secondary as well, and you guys are you're well familiar from that. So primary market transactions can occur directly. In other words, you, TELUS, sells the securities directly to investors. Could be you and I, as retail investors. And then they can also sell the securities to an institutional investor, like a mutual fund. And then that way, the mutual fund has a certain amount of holdings in TELUS within their portfolio, and somebody's investing in the units of that mutual fund, which has a certain percentage of its holdings in TELUS shares. Yep, there we go. Here's what it looks like. Basically, companies and investors can deal directly. They can deal with an investment dealer as an intermediary, and they can deal with financial intermediaries such as mutual funds. So lots of different choices for how those funds flow. So financial intermediaries are really important in our financial markets in Canada. They own a quarter of all stocks but make over 3/4 of all trades. That gives you an idea of how important mutual funds and things that are similar to mutual funds, entities that are similar to mutual funds, play a major role in how Canadian markets trade every day. Examples include mutual funds, pension funds, and insurance companies. So a company like BCI, BC Investment Corporation, that you might be familiar with, they are an arm's length crown corporation that invests pension funds. So they are in that middle bullet, pension funds, and they are doing a significant amount of trading. And you can imagine what an Ontario pension fund looks like as far as the numbers of billions and billions of dollars that they are trading on behalf of their future pensioners and current pensioners, and banks and trust companies. Okay, stock markets and stock exchanges. Basically, a stock market is a network of exchanges and brokers, and then the exchanges are physical or electronic marketplaces. Generally, almost all exchanges are now electronic. There's very few in North America that are physical, if any. I even think some of the commodities markets are now electronic. There's still people running around doing stuff, but it's not the trading floor where you actually rented a space on the floor and with gestures and words would signal trades and have paper running around being passed around. That was the olden days. Now we're in an electronic marketplace for most exchanges. And brokers are the people who are licensed to buy and sell securities on behalf of you and I in the market. They work for brokerage firms. The securities exchanges. So the TSX is our main, the Toronto Stock Exchange, is our main board in Canada, our main stock exchange. That's where all of the sort of big, like TELUS companies, trade their stocks. There's a TSX Venture, which is a different exchange based in Calgary, and that is for companies that are smaller. Their shares might trade under $1 per share. So mining companies, smaller companies deal on the TSX Venture. Big companies are on the TSX and traded on there. There's specific requirements to be listed, including the fact that your shares need to trade over $1 per share. So in order to be on the TSX, one of the qualifying features is your shares have to be worth more than $1 per share, and that's why some of the TSX Venture companies trade on the TSX Venture. They're not allowed to trade on the TSX because of a lot of things, but also because of their share price. Over-the-counter market means that some stocks don't trade on a stock exchange. They sort of trade on an outside over-the-counter market. Very low volumes, right? So, stock exchanges exist to trade very high volumes of shares between different entities. Over-the-counter market tends to be, I've got shares in this smaller company. It's kind of public. And what I do is I sell them to somebody over the counter, but there's not a lot of buyers and there's not a lot of sellers, and there's not a lot of buyers in particular on over the counter markets relative to a serious stock exchange like the TSX. So the role of brokers. Brokers basically help you set up an account. They'll buy and sell your orders, and then specialists make markets in really specific securities like options and fancy things like that. And then confirmation of trades are made with all the entities that are involved to indicate what the brokers did on behalf of their client. or what the brokers executed on behalf of their clients' instructions. So market regulation, there are 10 provinces and 3 territories, each regulating their own security markets. Ontario Securities Commission, as I mentioned Wednesday, is the most influential. It has the TSX. So if you're going to trade on the TSX, you have to meet the Ontario Securities Commission rules. So that gives them a lot of power, but it doesn't give them all the power. And they generally, securities laws, whether it's in the Canada or the US, are designed to protect investors. So, they don't want insiders trading, and they want to make sure that companies are disclosing accurately and fairly all of the information that investors might want, so that they can be protected basically from somebody lying to them, and providing misleading or false information, and having investors act on that information. So that's their job. And so what they do is they look at filings, right? They'll review your quarterly filing for TELUS, and if they're not happy with some of the things in it, they'll ask for clarification, proof, greater explanation before you can properly file, and have accepted your quarterly reports that you file to the Securities Commission. So they generally do. They generally do push back in a number of places. They generally have questions for most filings. It's very rare for a company to submit a filing and not have any questions back from the Securities Commission that it has to address in order to file its return. It's more common to have questions than. So going public, if companies want to go public, they can become a publicly traded company. Private means that the companies shares are not only held very closely by a small group of people, but they're severely restricted by regulation compared to publicly traded companies, which give people the right to trade them, right, with the I guess not guarantee, but the I don't know, the blessing of the Securities Commission that the information that they're being provided as a public investor is good information, the annual reports, the quarterly reports, and making sure that those are accurate. The process of obtaining approval to move from a private company to become a public company is the process that's known as going public. So you issue a prospectus. You would use an investment dealer to determine if anyone would like to buy your shares and what you might price them at. The prospectus is a legal document providing detailed information about the company, which has to be reliable and verifiable. So it's an actual legal process to develop a prospectus. It's provided to the Securities Commission, who reviews it and makes sure it's accurate. They want to see evidence for some or all of the claims that are within the prospectus document. And when it's not yet approved, it's called a red herring. And then once it's approved, it's called the prospectus. Then once the prospectus is approved, the sale process can start. And investment dealers try to line up buyers. They do a roadshow with the company to get investors interested in the company. A bought deal is a deal where securities are purchased by the investment bankers who are participating and selling basically the shares. So if TELUS has a bought deal, then what that means is that all of those shares will be placed and all of that money will be received because the investment bankers will take the shares and buy the shares if their customers don't want them. And that's compared to a best efforts deal. So a bought deal means that all the shares are taken up. A best efforts deal means that the investment bankers have only agreed to try their best to sell the shares, and the company may or may not get all the money that it's trying to raise. It just depends on how successful the entire offering is. The process of going public is the over-the-counter market is the over-the-counter market is the smaller market. We talked about that. So after a company goes public, its shares will trade in the over-the-counter market, and then as it gets larger and the shares are worth more, then it can move up to the big markets. Now, big companies going public, like say a Facebook, they go right to the main market. But some smaller companies that are, mining, oil and gas, or even tech could start off on the over-the-counter market, sort of maybe go to the venture exchange and then move on to the big board when they have, a really viable, mature company that's trading, high quality, high value shares. So a firm may wish to be listed on a stock exchange like the TSX, but they have to meet the requirements as I mentioned. This is not important, so don't worry about stock market quotations. We're dealing with that separately, and I'm tracking that for you. This is not how we look up stock quotations anyway. You do a Google search, right? Sorry about that. You do a Google search, and yeah, that's how that works. Interest rates. You guys know a lot about interest rates. There are many interest rates, prime rates, bank rates, etc., but they all tend to move together. So, one goes up, they all go up. With, as we discussed in the very first session, the monetary policy of Canada, the Bank of Canada drives interest rates and decides basically what is going to happen to interest rates, and everybody else follows along. So the stock market. So equity and bonds compete for investor dollars, right? Shares are more risky and they offer more reward. But if interest rates go up, bonds become more attractive because they're less risky. So if you're suddenly getting more return in the bond market, but it's a less risky investment than equity, you might move some of your investment out of the equity market into the bond market to get those higher interest rates, right? So they compete for money, these two different markets. So the required return on shares rises and the price of shares falls when interest rates go up. They move in opposite directions essentially, which again, back to this idea of when interest rates rise, bond prices go down too. Rising interest rates are hard on an economy, right? And so that's where we are. We have to have rising interest rates or stable because there's not really any place to go down from here, as we discussed in our first residential. Okay, interest rates are set by supply and demand. Basically, if somebody's not willing to lend at a certain rate, well, rates are going to have to come up, right? And if borrowers want to borrow at a certain rate, if they can find a lender, they're going to take whatever that lender's offering. So there is a supply and demand curve when it comes to interest rates. So we can just go through these and take a look at them, but they're pretty straightforward. So the price is ultimately the interest rate. And as we discussed on Wednesday, we can break it down into its components. The base rate, which is the pure interest rate plus an inflation adjustment. We talked about that being approximately 2%. And then the premium for the risk, default, liquidity, and maturity. So the default again, pure is the pure plus the no inflation. But we talked about inflation a lot. We did that. So back to the risk premiums now, though. This is the more important part. So the default risk is the chance the borrower won't pay the principal or will be late on repaying the principal. The liquidity risk is that you can't, once you've made the investment in the bond, say you've got a 30-year BC Ferries bond. Well, that's okay if there's enough buyers out there so that in 5 years, if you decide you don't want to hold that bond anymore, you can find a buyer in the secondary market. But it's not okay if you're holding, the shares of a really small company that no one knows that trades over the counter. And so I'm back into let's switch. Sorry, let's switch it back into debt. Say you have some commercial paper. Somehow some small company issued some commercial paper, and you happen to own that commercial paper, and there's no real secondary market for it. That's a really high lending risk, or that's a really high liquidity risk, because you can't convert that paper back into cash very easily. So the longer the bond, the less of a market there is, a secondary market for that bond or debenture, the more liquidity risk there is as far as your ability to convert it back into cash if you change your mind before maturity about owning that particular piece of paper. And then the maturity risk. The longer that the bond is till it matures, till the term, the longer the term, the more likely interest rates will change, and therefore it's got a fairly high amount of risk. Because risk, remember, is not just that things will go in a certain direction, in one direction. Risk is also about volatility, the fact that things go up and down over time. And so when we talk about risk, we're talking here about the up and the down of the maturity risk and the volatility of the value of that particular bond. So we put it all together, we add all those pieces together. The risk-free rate is federal government T-bills 90 days. That's what we use as our standard in Canada, actually in North America. Although sometimes the 10-year long bond is used in companies. And again, that would be an interesting question to ask our executive in residence. What is TELUS doing these days when it calculates its cost of capital? This risk-free rate we're going to use later when we calculate share valuation in CAPM. So remember, risk-free rate, 90-day T-bill rate. That means it's the least risky investment opportunity out there. Federal government, 90-day bonds, super. Yeah, we've covered that. The real interest rate is the idea of incorporating inflation into the interest rate so that we make sure that we're not just losing money. I mean, think about the overnight lending rate, which was at what, 0.75 or 0.5%. And with interest at 2%, you can't invest something at less than 2%, and because you're losing money. If inflation goes up by 2% and you made 1.5%, well, you're not making back that dollar's worth less today than it was a year ago. So you have to make at least inflation when you're looking at your investments. So we need to consider that when we're looking at interest rates in general. And then finally, yield curve, which we talked about quite a bit in class the other day. Basically, we have short-term, long-term, and medium-term interest rates, and we calculate them out. And here's what it looks like. And we generally get a blue line where the short-term interest rates are the lowest, the middle-term, medium-term interest rates are in the middle, and the longer-term interest rates are higher, which makes a lot of sense based on everything we talked about earlier, the different risks. And it goes inverted, the red line, just prior to a recession in 8 of the 9 last recessions. The recession generally occurs about 18 months later. And unfortunately, well, these were the theories as to why that might happen. And we talked about those Wednesday. They're pretty straightforward, but just ask if you have any questions there. But they don't fully explain actually the term structure of interest rates. All three explain a little bit of the variability, but all three together don't fully explain term structure of interest rates. So it's a